Something important is happening in North American trade, and once again, it isn't unfolding with dramatic announcements or urgent speeches. There are no flashing warnings, no official declarations of crisis, and no immediate sense that the system is breaking down. Yet beneath the surface, a significant shift is taking place. Canada has raised tariffs on certain US goods to as high as 45%, and while that number alone is enough to draw attention, the real story lies in what this decision represents rather than how loudly it is being discussed. This isn't just a policy adjustment, it's a signal, and like many signals in global trade, it's being sent quietly, carefully, and with intention. Hi, I'm Janus Juno. Thanks for being here. Today's conversation isn't about panic or blame, and it's not about choosing sides. It's about understanding how trade decisions ripple outward, why timing matters, and what this moment reveals about the broader economic relationship between Canada and the United States. At first glance, a 45% tariff sounds extreme. Tariffs at that level are not symbolic. They have real consequences. They change prices, disrupt supply chains, and force businesses to reconsider where and how they operate. For American retailers and importers, this kind of increase creates immediate pressure. Costs rise quickly, margins tighten, and difficult decisions follow. Some of those decisions are passed down to consumers, while others reshape long-term strategies behind the scenes. But tariffs don't exist in isolation. They are almost always a response to something else, a negotiation, a dispute, a perceived imbalance, or a broader shift in policy direction. To understand why Canada took this step, we have to look beyond the number and focus on the context in which it was introduced. Canada and the United States share one of the most interconnected trade relationships in the world. Goods cross the border daily, often multiple times before reaching their final form. Manufacturing, agriculture, energy, and retail are deeply intertwined. Because of this integration, even small changes can have outsized effects. A large change, like a 45% tariff, inevitably draws attention from businesses on both sides of the border. For US retailers, the immediate concern is cost. Higher tariffs mean higher import expenses, which can quickly erode profitability. Companies operating on thin margins feel this pressure almost instantly. Some may absorb the cost temporarily, hoping the situation stabilizes. Others may pass it on to consumers, contributing to higher prices. In either case, the impact is real and difficult to ignore. However, it's important to note that Canada's move doesn't appear designed to provoke chaos. There has been no aggressive rhetoric, no framing of the decision as a punishment or a threat. Instead, the adjustment has been presented as part of a broader trade posture, one that reflects changing priorities and growing sensitivity to economic leverage. This distinction matters. When trade measures are framed calmly rather than confrontationally, they signal strategy rather than emotion. Canada's approach suggests a desire to protect domestic interests while maintaining room for negotiation. It's not about severing ties, it's about recalibrating them. From a broader perspective, this moment reflects a shift in how countries are using economic tools. Tariffs are no longer just defensive measures or bargaining chips. They are increasingly used as signals of alignment and expectation. They communicate dissatisfaction, caution, or a need for adjustment without resorting to open conflict. For American businesses, this creates a complex environment. On one hand, the US remains a dominant economic force with significant leverage of its own. On the other hand, partners like Canada are demonstrating that they are willing to assert their interests more clearly when conditions change. This dynamic forces companies to think more strategically about risk, diversification, and long-term planning. It's also worth considering how this fits into the global picture. Around the world, trade relationships are under strain. Supply chains that once felt stable are being re-evaluated. Governments are paying closer attention to dependency, resilience, and domestic capacity. In this context, tariff adjustments are becoming more common, not less. Canada's decision is part of this broader trend rather than an isolated event. What makes this situation particularly interesting is the absence of alarm. Despite the scale of the tariff increase, the reaction has been measured. Markets have noted it. Businesses are adjusting. Analysts are watching. But there is no sense of collapse. That calm response suggests that many actors anticipated some form of adjustment and had already begun preparing for a more fragmented trade environment. From my perspective, this moment highlights a growing reality. Economic relationships are becoming more conditional. Trust still matters, but it is increasingly paired with verification and leverage. Countries are less willing to assume stability and more willing to test boundaries when they feel exposed or undervalued. For the United States, this raises important questions about how trade partnerships are managed and perceived. Tariffs at this level don't emerge in a vacuum. They reflect negotiations that didn't fully resolve underlying concerns. Understanding those concerns is more productive than reacting to the number itself. For retailers and trade-dependent industries, the challenge now is adaptation. Companies that can adjust supply chains, renegotiate contracts, or diversify sourcing will be better positioned to absorb the impact. Those that rely heavily on established patterns may face tougher decisions ahead. As we move forward, the key issue isn't whether tariffs will go up or down in the short term. It's whether trade relationships can regain a sense of predictability in an environment where economic tools are increasingly used as signals rather than last resorts. This moment between Canada and the United States is one example of a larger shift. It shows how even close partners are navigating a world where certainty is harder to maintain and flexibility is becoming essential. The implications of that shift extend far beyond retail and trade figures. They touch on how countries define cooperation in an era of constant adjustment. In the next part, we'll look more closely at what this tariff increase could mean for future negotiations, how US policy responses might evolve, and whether this moment represents a temporary adjustment or a longer-term change in North American trade dynamics. To understand where this situation may lead, it helps to look at how trade decisions like this usually evolve over time. Tariffs at this level are rarely meant to be permanent. They are pressure points. They exist to influence behavior, reopen conversations, or rebalance leverage. In that sense, Canada's move can be seen less as an endpoint and more as the middle of an ongoing negotiation. What's different now is the environment in which that negotiation is taking place. Economic relationships today are shaped by far more than price and volume. Political stability, supply chain resilience, domestic employment, and even public perception all play a role. Governments are increasingly sensitive to how trade decisions affect voters at home, not just partners abroad. That sensitivity changes how quickly compromises can be reached. For US policymakers, a 45% tariff from a close partner creates a dilemma. Responding aggressively risks escalation. Ignoring it risks appearing passive. Finding a middle ground requires careful signaling. This is where diplomacy becomes as important as economics. How the United States frames its response may matter just as much as the response itself. American retailers are watching this closely, but they are not the only ones. Manufacturers, logistics companies, and suppliers are all part of the same ecosystem. When tariffs rise, the pressure doesn't stop at the border. It moves through contracts, pricing strategies, and long-term investment plans. Companies that had already been considering diversification may accelerate those plans. Others may begin reassessing their dependence on cross-border trade entirely. Canada's position, meanwhile, reflects its own balancing act. As a major trading partner of the United States, it benefits from cooperation and stability. At the same time, it must protect domestic industries and signal that it will act when it feels exposed. Raising tariffs is a way of asserting agency without closing the door to dialogue. It communicates seriousness without resorting to confrontation. This approach aligns with a broader trend among mid-sized economies. Countries that are deeply integrated into global trade are becoming more assertive about managing risk. Rather than waiting for disruptions to force change, they are proactively adjusting policies to create leverage and flexibility. Tariffs, in this context, are one of several tools being used to shape outcomes. There is also a strategic dimension that goes beyond bilateral trade. Canada's decision will be observed by other US partners. How Washington responds will influence expectations elsewhere. If the situation is resolved through negotiation and adjustment, it reinforces the value of dialogue. If it escalates, it may encourage others to adopt similar tactics. In global trade, precedents matter. Another factor shaping this moment is economic uncertainty. Inflation, interest rates, and supply chain disruptions have already strained businesses. Adding tariff pressure into that mix compounds the challenge. Retailers operating in competitive markets have limited room to maneuver. Some may absorb losses temporarily. Others may adjust product offerings or sourcing strategies. Over time, these adjustments can reshape entire sectors. From a consumer perspective, the effects may not be immediate, but they are likely to be felt. Higher costs often work their way downstream. Price sensitivity varies by product, but sustained pressure eventually shows up on shelves. That reality adds a political dimension to trade decisions. Governments must consider not only economic metrics, but public tolerance for rising prices. This is why moments like this are often handled quietly. Loud rhetoric can box leaders into positions that are difficult to retreat from. By keeping the conversation measured, both sides preserve room to negotiate. Silence in this case is not indifference, it is strategy. What we're seeing here is not a breakdown of the US-Canada relationship, but a test of how resilient it is under stress. Strong partnerships are not defined by the absence of conflict, but by how conflict is managed. Tariffs create friction, but they also create incentives to engage. From my perspective, the most important question is not whether tariffs will remain at 45%, but what lessons are being drawn on both sides. Are policymakers using this moment to address underlying issues or simply reacting to symptoms? The answer to that question will shape the next phase of the relationship. This situation also highlights how interconnected trade has become with national strategy. Decisions that once belonged purely to economists now involve security analysts, political advisors, and industry leaders. That complexity makes outcomes harder to predict, but it also encourages more holistic thinking. As we look ahead, several paths remain possible. Tariffs could be adjusted downward as negotiations progress. They could remain in place as leverage, or they could trigger further responses. What determines the outcome will be communication, timing, and willingness to compromise. For now, what's clear is that this moment represents a recalibration rather than a rupture. Canada has asserted its position. The United States must decide how to respond. Businesses are adapting, markets are watching, and the broader system continues to adjust to a world where trade relationships are more conditional than they once were. In the final part, we'll bring these threads together and look at what this moment tells us about the future of trade between close partners, how economic pressure is being redefined, and what this could mean for stability in an increasingly uncertain global economy. When we look at this situation as a whole, it becomes clear that the tariff increase itself is only one layer of a much larger story. What truly matters is what this moment reveals about how close trading partners are navigating a world that feels less predictable than it once did. The US and Canada are not adversaries. They are deeply connected economies with shared history, shared borders, and shared interests. That makes moments of friction more meaningful, not less. A 45% tariff is not a casual adjustment. It reflects a willingness to apply pressure, but also a desire to be heard. Canada's move suggests that traditional assumptions about automatic alignment are being revisited. Cooperation is still valued, but it is no longer unconditional. That shift doesn't signal hostility. It signals caution. And caution, in today's global environment, is becoming a common response to uncertainty. For the United States, this moment invites reflection rather than reaction. Trade policy is not just about defending domestic interests. It's also about maintaining trust with partners who rely on predictability. How Washington chooses to engage now will shape expectations well beyond this specific issue. A measured response can reinforce stability. An escalatory one could introduce unnecessary volatility into an already complex system. From the perspective of American retailers and businesses, adaptation is the immediate priority. Companies that are flexible, diversified, and forward-looking are better positioned to manage this kind of disruption. Those that depend heavily on established patterns may feel more strain. Over time, these adjustments influence where investments flow, how supply chains are designed, and which markets feel most resilient. What stands out in this situation is the absence of dramatic rhetoric. There have been no urgent warnings of collapse, no sweeping claims of crisis. Instead, there has been quiet recalibration. That calm tone suggests an understanding on both sides that escalation would serve no one. In many ways, this restraint is the most encouraging signal. It shows that even under pressure, dialogue remains possible. This moment also reflects a broader evolution in global trade. Economic tools are increasingly used not just to protect markets, but to communicate expectations. Tariffs, incentives, and regulatory adjustments are part of a language that governments use to signal priorities. Understanding that language requires looking beyond headlines and focusing on patterns. In my view, the real takeaway here is not about winners or losers. It's about how cooperation is being redefined. The era of assumption is giving way to an era of negotiation. Partners are asserting their interests more clearly, while still leaving space for collaboration. That balance is delicate, but it's also necessary in a world where economic shocks travel fast and margins for error are smaller. As this story continues to unfold, the most important developments may not come from announcements, but from adjustments made quietly behind the scenes. Trade relationships are being reshaped incrementally through decisions that reflect caution, strategy, and long-term thinking rather than impulse. Whether tariffs remain at this level or are revised over time, this moment will likely be remembered as part of a broader recalibration in North American trade. It reminds us that even strong partnerships require constant maintenance, clear communication, and mutual respect. Stability is not automatic. It is built, tested, and reinforced through choices like these. If you appreciate calm, thoughtful analysis that looks beyond headlines, consider subscribing for more long-form discussions on global trade and world affairs. Share this video with someone who prefers understanding over outrage, and let me know your thoughts in the comments. Your perspective adds value to this conversation. I'm Janus Juno. Thanks for watching.